Hey everyone, what on earth is going on in the world? Not only is Buffett reducing exposure to US stocks and hoarding cash, but even crazier, Jim Rogers, the 79-year-old investment legend, the king of contrarian investing, who co-founded the Quantum Fund with Soros and turned $4 million into 200 times, that has outright cleared out his US stocks and gone heavy on gold and silver, especially silver. He's declaring that the US is facing its worst crisis. Gold and silver are the only real money, while most people are still hemming in. Implying about whether gold is too expensive or if US stocks are still okay, the big players have already taken action, diving headfirst into hard assets. What signs have they spotted that we've missed? And the market is indeed playing out, just like the Masters predicted right at the start of September. The money god gave us a winning opening. Gold smashed through the $3,500 mark, and silver, which 90% of people totally overlook, quietly broke through $40. A massive wave is brewing right under our feet. This isn't just some ordinary commodity hype. It's a super trend driven by the convergence of three powerful forces: national strategy, industrial necessity, and financial turmoil. It's like an undercurrent that could reshuffle the wealth of ordinary people at any moment today. Let's follow the clues of this gold and silver surge, breaking down the policies, the industries, the money flows, and the trading psychology for you. After listening, you'll understand why is Rogers ditching US stocks to bet on gold and silver? Why will the Fed's first rate cut directly benefit gold and silver? Can ordinary folks still invest in US stocks? And most crucially, can you still jump on this gold and silver frenzy now? How do you get on board? And when must you absolutely jump off? To answer these questions, let's start at the source. Why are gold and silver rising? When trying to figure out what caused the current world economic problems, I have a little trick. It's simple. First check if Trump had something to do with it. This little trick is right about 80% of the time. Okay, enough talk. Let's look at the first and core reason for this rally. Is it related to Trump? Yep. Everyone knows about Trump meddling with the Fed, right? Has basically turned on the full money printing signal. Under Trump's constant pressure, Fed Chair Powell recently said that risks in the labor market are more concerning than inflation, which translates to we're about to loosen policy. The impact was immediate. Check out the latest CME FedWatch data. The probability of a 25 basis point rate cut in September shot up to 87.4%. The September 6th non-farm payrolls, September 11th CPI, and September 18th the FMC meeting are like three blades hanging over Wall Street. Historical experience tells us that once the Fed enters a rate-cutting cycle and starts turning on the money printers, gold and silver as zero-yield assets often become the preferred safe haven for capital. Why think about it before you could earn interest keeping money in the bank? Now, with rates cut, money sitting around loses value. So what do people do? They go crazy buying hard assets that don't go bad, like gold and silver. Looking back at history, do you remember the 2008 financial crisis triggered by the US subprime mortgage mess? Bad debts soared, and just like now, the Fed turned on the money printers. What happened? Gold prices surged massively from October 2008 to 2011. Gold rose from $700 to $1,920, a gain of about 140%, and silver was even wilder. Although its price fell during the crisis, it recovered and skyrocketed afterwards, shooting up from under $10 to nearly $40, a gain of roughly 300%, more than double gold's increase. Pretty shocking, right? Then look at 2020, the COVID-19 pandemic hit. Central banks turned the money printers on again, big splash, and it was another period of a weak US dollar. So the gold market had another glorious year, gaining nearly 25%, its highest annual return since the end of the 2010 surge. Compared to gold, silver's performance was even more impressive, rising nearly 50% year on year. Comparing these two precious metal surges, we see history repeating itself in a striking way. The pattern is first a weak dollar, then money printing and rate cuts, finally gold and silver soar. The script today isn't fundamentally different from back then. They've just turned up the stage lights even brighter. Now let's look at the second major factor behind the gold and silver surge. This too stems from Trump's interference with the Fed. The collapse of the global bond market. Why blame Trump? Because he's amplified political uncertainty, policy volatility, and market instability, fueling a sell-off in US Treasuries that's now spread to global bond markets. Let's see what he's done recently. One announced the removal of Fed Governor Cook using mortgage fraud as a reason to criticize Fed Chair Powell. 3. Fired the head of the Bureau of Labor Statistics, Erica Manson-Tarfer, using the poor July jobs report as the excuse for pushed for the U.S. to acquire a 10% stake in Intel Incas. After this one, two punch of moves. Can you feel the storm coming? Is Trump about to switch on full government intervention? MoGeoQuant data shows the U.S.'s current political risk score is 41.79, already nearing the average of 44 for 28 emerging market countries, and not even that far from Turkey's 51.31. Remember, Turkish President Erdogan repeatedly interfering with central bank interest rate decisions is a cautionary tale. Let's see how that turned out. Soaring inflation and a plunging lira. This July Turkey CPI rose 33.5% year-on-year, and lira hit a record low against the dollar. Looking at Turkey and then back at Trump, isn't that terrifying? So it's no surprise that as treasuries are being dumped, the dollar was already weak, and now with this, investors are worried Trump's strong-arm tactics could undermine the Fed's independence, driving up inflation expectations and hammering the dollar and treasury market. But is this just a us problem? Of course not. The treasury sell-off has spread worldwide. The UK, China, Japan, Australia are all selling, and that's not all. The treasury dump is just the trigger. German, French, UK, and Japanese bonds are all getting hammered too. The global bond market collapse made August a ACT dark month for bonds. Clearly, rate cuts can't save the bond market. Instead, bonds are slapping back with plunging prices. The more central banks print, the higher long-term rates go. The market is voting with its stop lying, your credit is bankrupt. But for gold, this is bullish. The dollar's appeal is fading. Central bank credibility is crumbling. Safe haven demand is rising. All long-term positives for gold. Money is smart when the supposedly safest bonds start running naked, completely losing their safety. There's only one place left for capital to flee to: hard assets. See, you can actually connect all these reasons into one clear chain reaction. A weak dollar pushes Trump to pressure the Fed for easier money. This meddling shakes confidence in the Fed's independence, which worsens the sell-off in its treasuries. That sell-off then triggers a collapse in the global bond market, and because the bond market is crashing, the credibility of central banks crumbles along with it. It's one thing leading to another, a domino effect, as safe haven sentiment gets stronger and stronger. Allocating to protective assets naturally becomes a top priority for every investor. Now for the third reason, also tied to Trump: geopolitical turmoil. Really, nowadays, what turmoil isn't linked to Trump. Recently, the international situation has been turbulent. Domestically, Trump's sanctions against the Fed have sparked a constitutional crisis over its independence. Internationally, he's waving the tariff stick at the world, sanctioning India one minute, stabbing Ukraine the next, then serving up Europe on a platter. We've talked about Trump's drama before, so I won't go into detail here. Check my page if you're interested. In addition, Russia just launched its second largest airstrike on Ukraine since the war began. And in this environment of soaring uncertainty, safe haven sentiment is through the roof. Gold has already hit a record high of $3,542.80, while silver's rise has lagged. The gold-silver ratio is still as high as 86 compared to a historical average of 50 to 60, meaning silver has huge catch-up potential. So we spelled out the root causes of the gold and silver surge, and we see they all boil down to two words: safe haven. History has proven time and again that when fiscal policy goes haywire, central banks fail, and bonds collapse, gold and silver are the last safe harbors. They don't rely on any government's promise, won't be swayed by some central banker's words. They're the world's recognized hard assets. In the past, during crises, people bought government bonds for safety and yields fell. But from 2023 till now, even with global conflicts flaring, bond yields haven't dropped, meaning bonds are no longer safe havens. The market is looking for a new safe harbor, and gold and silver are the natural replacements. That's why gold and silver have soared this year. Gold is up over 30% year-to-date, triple the S&P 500. Silver broke $40, and analysts have raised their targets from $43 to $46. This isn't just hype. It's the result of a repricing of the global financial order. Many people don't get it. Why are gold and silver outperforming while us stocks are still rising? The reason is simple. As stocks are rising on hot air, gold and silver on solid logic, the US stock rally is driven by AI hype and loose liquidity. It's built on inflated valuations that could be pulled back to reality by the bond market anytime, but the gold and silver surge is the inevitable result of three factors: out of control deficits, resurgent inflation, and a cracking credit system. One relies on stories, the other on real demand. Investors know the score. And furthermore, the safe haven nature of money is now wide awake. After over a decade of low rates, everyone loved stocks and bonds, but now bonds aren't safe. So money is fleeing to assets that won't welch. Or default gold and silver are the safest choices. But hold up, if both gold and silver are soaring, why is Roger so focused on silver? And why does silver historically outperform gold in every financial crisis? What's the magic of this often overlooked poor man's gold? Roger's reason is straightforward. The legend who called the top of the dot-com bubble in 1999, the US stock market in 2008, put it simply: Gold is too expensive, and silver is hugely undervalued. Yep, since the Russia-Ukraine war started in 2022, gold has climbed from $1,600 to a high of $3,500 per ounce. But silver seriously lagged in April this year. The gold-silver ratio shot up to over 100, meaning 1 ounce of gold could buy 100 ounces of silver, way above the historical average of 60-80. JP Morgan's quant system found a pattern. Every time the ratio exceeds 85, silver has a major rally. Sure enough, money is now flooding into silver to fill the gap. Today, the ratio has fallen to around 86. Is that the top? No, silver's undervaluation isn't over yet. That's the first reason behind silver's potential explosion. The second reason is industrial demand. You gotta know the biggest difference between silver and gold. Gold is just a zero-yield asset. Silver isn't just a zero-yield asset. It's an industrial necessity. Only about 10% of gold is used in industry. Most is for safety and jewelry. But a whopping 55% of silver is used in industry. It's the industrial lifeline for solar panels, electric vehicles, 5G base stations, and military missiles. A single solar panel uses about 20 grams of silver. An electric vehicle uses twice the silver of a gas-powered car with the rise of green energy and 5G. This demand is only getting bigger, but the market hasn't fully priced this in yet. That's the opportunity. When industrial demand smashes into import barriers, the result can only be one thing: splitting prices. Citi's $46 target has already baked in half the expected tariff impact. The real move could be way wilder. A few years ago, due to high demand for lead and zinc, silver was mined as a byproduct. But back then, silver demand was low, so inventories piled up, hitting 50,000 tons at one point. Now, silver has been in a supply deficit for 6 straight years, with an annual shortfall of 5,000 to 8,000 tons. Over these years, inventories have dropped to around 10,000 tons at the same time. Mine supply is hitting a bottleneck. The top 5 silver mines globally are seeing lower ore grades, frequent strikes, and insufficient investment. New capacity is too little, too late, even worse. Industrial recycled silver is being locked up by solar companies at high prices, sharply reducing market supply. What does this mean? It means silver's time has come. With low inventories and rising demand, prices have to go up. The third reason is a recent policy tailwind. The U.S. Geological Survey suddenly plans to add silver to the 2025 critical minerals list. If that happens, import tariffs could go up by 50%. The U.S. relies on imports for 64% of its silver, mostly from Mexico and Peru, with China being the top refiner on the surface. Washington's move is about supply chain security, but in reality, it's about locking down strategic resources early, making global manufacturing pay us tariffs. We've seen this script with steel, aluminum, even rare earths. First list as critical, then launch a Section 232 investigation, then impose tariffs, finally, prices double. Now it's silver's turn, and it's deadlier than steel because steel has substitutes. Silver in solar panels and missiles does. NotCity boldly raised its target to $46, but is $46 the peak? Not necessarily. Tariff expectations plus supply gap plus money rushing in silver has even more potential. You could even say it has to rise. Finally, the ultimate question: how high can gold and silver go? Will there be a short-term pullback? Sure. If September 6th non-farm payrolls beat expectations, silver might pull back to $37. If September 11th CPI comes in hot, the market will fret over Fed wording. But remember, the final vote on the tariff list is October 19th. Before then, any dip is a chance to hop on. But what really determines the peak isn't the charts. It's the end of the global debt cycle. When US, UK, and Japanese debt all hit their interest payment limits, central banks have no choice but to print money. Currency purchasing power collapses, and gold and silver become the only honest anchors. This isn't an ordinary rally. It's a currency revolution ignited by bonds, fiscal policy, industry, and geopolitics all at once. $40 silver and $3,500 gold are just the opening act. The real script is global central bank bankruptcy and hard assets being repriced. Finally, let's zoom out. Dollar hegemony is visibly wobbling de-dollarization from the Russia-Ukraine conflict. The petrodollar loosening in the Middle East. Trillion-dollar treasury markets have lost their tide. Fed independents were torn apart by politicians. Rogers cleared out U.S. stocks and half went to gold and silver. Buffett is cutting us stocks and hoarding cash when the old order collapses. Don't stand on overvalued bubbles. Stand on scarce hard assets. Gold is, of course, the safe haven everyone wants, but silver. That forgotten monetary ghost is making a comeback as the new king of industrial blood. $40 is just the appetizer. $46 is just the halftime show. The real endgame might be a gold-silver ratio back under 50. When that day comes, you'll find today's anxiety, hesitation, and fear of missing out will turn into a casual. Good thing I understood back then. So don't ask me if silver can hit Ruger's portfolio already answered that. Don't worry about whether non-farm payrolls will crash the market. The tariff list has already written the script. Don't wait until everyone gets it. By then, prices will be out of reach. The market always rewards those who see it first and punishes the latecomers. Tonight, you only have two choices. Either become part of the story or become part of the audience. Comment below and tell me, do you think silver can break $46 in September? Don't forget to like and subscribe. I'm Luna here to help you translate macro trends into numbers in your trading account. That's all for today. See you tomorrow.